Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. We got another awesome show today. Our guest is Mike Maples Jr., partner at Floodgate, pre-seed, seed stage venture capital firm, invested in companies you guys know like Twitter and Lyft and Twitch. Mike became an author, released a book titled Pattern Breakers: Why Some Startups Change the Future. Today, we're going to talk with Mike about what he's learned from studying successful seed stage investments, how some of these ideas can apply to you as an investor, entrepreneur. Mike, welcome to the show.
Thanks, Meb. It's a pleasure.
We're going to talk about your awesome book, Pattern Breakers. Maybe let's just set the pavement for a little bit. You mostly operate where? Seed stage, Series A, pre-seed?
Yeah, I like to say that I invest too early, way too early, or even legally ambiguously too early. And so, when we invested in Twitter, they were deciding whether to call it voicemail 2.0 or TWTTR. My advice was to put the vowels back in. It's probably the only advice that Ev ever took. And then Elon took all the vowels out. So, when he renamed it X. And then, I invested in Twitch when it was Justin.tv. And my colleague, Ann, invested in Lyft when it was Zimride. And they decided to launch this ride-sharing service with pink mustaches. And in the board meeting, the only downside is it's illegal. And what are we going to do about the fact that we're about to launch something that's an illegal service? A lot of these companies, and some of them that I said no to, foolishly, Air, Bed, and Breakfast, before it was called Airbnb. These things are pretty wild and pretty early at the time that we have to decide whether we want to get in trouble with these people.
Well, it's funny because all those that you just mentioned, I wouldn't say they all had a pivot, but they may not have, where they are today, have been when they were at the seed stage idea. It may not even been why you would have invested. Maybe talk a little bit about at y'all's stage, how to even think about that. Is that something where, is it a luck sort of tangent? Is it more that you just invested in the right people and they figure it out? How do you think about that on the really early stage?
I'll say it's a humbling game. And so Warren Buffett, I've heard him say before that rule number one is don't lose money. Rule number two is don't forget rule number one. That's in the world that he plays. In the world that I play, rule number one is don't pass on Airbnb, because had we said yes to it, we would have made 5,000 times our money on that investment. And so, and we've had some that were really good, not quite any that good, but we've had some really good. So the interesting thing about seed investing is you're less interested in a margin of safety and avoiding failure, and you're more interested in how asymmetric is the upside if it works, because you're taking such incredible risk that you have to get paid when it goes your way. You got to get paid for the risk you take. And so it doesn't make sense to make a bet on. So, strikeouts don't matter, but base hits don't either, because you don't get base hits don't compensate you for the risk you took. You're swinging as hard as you can at a chance of a grand slam, so that if you do make contact, you'll make very solid contact. So it's a very different way of showing up in the world, right? It's a low probability, massive upside type of investment. And because you have very little data about the company, you don't have any customers yet, you don't have revenues, all the things that Buffett talks about, compounding and moats. Startup doesn't have any of those things. There's nothing to compound yet. And so you have to bet on the potential, and you have to come up with ways of identifying signal of great upside potential even before it's realized. And so you have to get comfortable with the idea that you don't know exactly how the dots are going to forward connect, and you don't know exactly how you're going to get from point A to point B. But you need to believe that the idea embodies a set of powers that allows it to have wildly asymmetric upside if it works.
You hit the nail on the head with public market investor. Just to show someone, say, hey, look, I got a stock for you. Here's a nice upside case. It can be a double, or this thing could even triple, be a 5-bagger. You know, if you go on CNBC, you're like, this thing's going to 5x the next couple of years. Like, when that happens, people will just lose their mind, be like, oh my God, this is amazing. This thing doubled. But in y'all's world, not to say that that's a bad outcome, but it's almost like the ones that really drive the majority of returns are the ones that are 50, 100 times up. So it's almost like, you know, these ones that are doubles and triples in terms of 2, 3x. It's not that you don't want those, but it's like the goal is the 100, which is a weird way to kind of retrain that muscle.
That's right. And Meb, it turns out that you actually don't even want them. And here's why. Let's in a typical fund that we have, we'll make about 40 investments. And if we succeed, let's say we want to have a 5x fund, which is pretty good. Then our best investment out of the 40 by itself needs a return 2.5x the fund or more. Because the way our business works is not a normal distribution curve, right? It's a power law. And so the biggest outcome is bigger than all the other outcomes combined. And so the 2x outcome, I mean, it's nice to make 2 times your money. It's nice to make 3 times your money, but it doesn't impact the fund's performance. The one that impacts the fund's performance is the magnitude of your best one. And so your best one has to be really big if it's going to be awesome. And so, you know, let's just use raw figures or ballpark figures. If you have a $100 million fund, you want to be 5x. $500 million of exit profits means you have to make $250 million in exit profits on your single best investment. And, you know, if you're making investments about, you know, $1 to $2 million each first check, that's a pretty big multiple, right? That's over 100 times your money. And that turns out to be right. You know, you have to get more than 100x about 5% of the time, and more than 20x about 15% of the time if you want to be great. But the rest of it doesn't matter. It doesn't matter how many 2x's you have or 5x's or any of those, because it's always nice to make money, but you have to make enough that you got paid for the risk you took.
What should people be looking for at this stage? How have you kind of been able to figure out and look at all the noise at such an early genesis of a business and say, hey, look, my pattern recognition here is that this is what matters to a seed stage investor?
Yeah, so here's the way I've internalized it, Meb. And what I came to believe is that a startup capitalist adds value differently than a corporate capitalist, than a normal business person does. So a normal business person adds value the way we always think about, you know, competitive advantage, compounding, sustainable moats. But like a startup capitalist, better doesn't matter in startups. And the reason is that if you're better, you're not going to get paid for the risk you took. You're not going to get a result that's worthy of the sacrifice of entrepreneurship. And so I like to say that a great startup has to be radically different, not just different, but radically different. And so some of your listeners, and this isn't a startup, but this will get the idea across, the Tesla Cybertruck. Do you like the Cybertruck?
My son loves it. Every
Okay.
kid I know absolutely loves this thing. I have my moments. Well, some days I wake up and I'm like, that is literally the ugliest car I've ever seen. And other days I'm like, you know what? Like it's definitely different. I drive the Model S. So let me say I'm a huge Tesla fan. Yeah.
Yeah, me too. I'm a total fanboy, right? But when I first saw him announce it, I thought maybe he was joking. Like, I was like, is he really going to ship that? And you may like the Cybertruck, you may dislike it, you might think it's ridiculous, right? But like, here's one thing. Nobody ever says, how does that compare to Ford F-150? The difference is self-evident. And it's like, Elon basically forces a very stark choice. He says, live in my future or don't. You know, the original Tesla Roadster, it would have never survived a normal comparison with a Porsche 911. The seats weren't as comfortable. The radio wasn't any good, but it was an electric car that nobody had ever seen before. It did a whole different set of things. So like what I've learned is that the great startups are that way. Nobody, when they saw Twitter, said, how's that different from blogs? Or when you got in your first Lyft ride for ride sharing, nobody said, oh, well, how's that different from taxis? As a startup, if you have to answer the question, how are you different from the incumbent offering, you already lost, right? Because now why would somebody buy from a company that's 80% likely to go out of business if they have a semi-credible alternative that exists? They won't. They're only going to take it from the startup if there's no other way for them to get that empowerment. And so, like, if you happen to like Cybertrucks, there's only one truck for you to buy. Like I like to say, in the world of startups, everybody sells apples. You're not going to try to be the 10 times better apple. You want to be the world's first banana. And you want to say, look, you may not value bananas, but for everybody who values the advantage of bananas, I'm the only guy that's got them. Come to Papa. And that's the place you want to be when you're a startup. And so when you're investing, right, that requires you to sort of show up in the world a little bit differently, right? You're not focused on what could go wrong, because most of the time it is going to go wrong. You're focused on how big could this be if it goes right? If people do choose this new way, if people do decide to break the pattern and go with a new pattern, how meaningful is that? And, could that be a household name like Twitter? Or are you kings of Dinkyland, even if you succeed? And so, that's kind of what we think a lot about.
It might have been Naval. I'm trying to remember, but someone on Twitter had actually a great comment that I stuck in my head a bit. As they said, Elon doesn't act like he's living in a simulation. He acts like he's living in his own simulation. And I thought that was kind of a really fun way to look at life. I was like, how would I act differently if this is like, turns out, Meb, this is a video game. You get to the end, you die, and it's just like, all right, that was a simulation. How'd you do? It's an interesting framework. All right, so let's talk about the book, Pattern Breakers. How does this kind of help us think about, both from entrepreneurship side, like in some of the ideas you're talking about? They definitely, I think it's really thoughtful. It reminds me a little bit of like Peter Thiel, the way he thinks about kind of the monopolistic, but in its own like category almost. Talk to me about this book.
I think there are two ways to think about it. One is if you're a tech entrepreneur, the benefits of the book are obvious, right? Because it kind of lays out a set of frameworks for thinking about technology startup ideas that are worth pursuing. And we can go into some of that. But if I zoom out, part of what I'm saying gets back to this Jonathan Living's seagull notion, which is you kind of have to decide at different phases of life whether you want to go with the flow and be a new and improved version of something and buy into the current set of rules and just play well within those rules, or if you want to be radically different. And only by being radically different can you make a radical difference in whatever it is that you do, right? Like, so anybody who listens to your show who buys stocks, the stock market may do well, and if you buy the index, you'll do well along with the stock market, but you won't outperform the average, right? You'll just benefit from the fact that the average did well. If you want to outperform the average, you have to take the risk of picking a stock. And, every stock is priced based on the wisdom of the crowds and what they think it's worth. And so anytime you buy a stock, in order to achieve overperformance, you have to risk underperformance relative to the index, right? And so like there's no free lunch there. The same is true of all things, startups, everything. So, the other day I was talking to somebody who read it, who has a bakery, and they said, I enjoyed the book, but I liked it because it had ambitious founders, but how does it apply to me? I run a bakery. I'm not going to leverage technology inflections. I'm not going to have some social platform or digital APIs or any of that stuff. And I said, well, there's this guy in Boston who had this thing called the Cronut that he just made up. And all of a sudden, he started attracting a lot of customers. In the supermarket, you have this 5-hour energy drink. And as far as I can tell, it's the same ingredients as Coca-Cola, basically, except it's in a smaller vial and they charge more for it. And I sit there and I think that's just brilliant. All these other knockoff colas try to be on the same shelf as Coke and have no chance of selling any. And they spend the same amount of cost of goods sold, everything else. And in comes this 5-hour energy drink. They're not even on the same shelf in the supermarket. And they don't even have the same use case as Coca-Cola. And somehow they pull that off, even though they basically have the same ingredients. And so I think that you can lean into your difference, regardless of whether you're technocentric or whether you're trying to scale a giant company. I think that there's always a chance to think, okay, what would I do if I chose to be different rather than better? And a lot of people don't realize that choice is available to us because we get rewarded for being better in all things, in school, and when we work out harder, we tend to get stronger. Most things, there's a direct relationship between doing more of it and doing better at it. And that's not true when it comes to breakthroughs.
So you're looking around these companies. How do you distinguish, when you're sitting there chatting with them, are there any key characteristics of these pattern breakers? Like, you're sitting across the table, you say, okay, this is one of those, or, like this, maybe not so much.
Well, yeah. So the first would be inflections. And I'm just out of curiosity, have you ever been surfing before?
We're right across from El Porto, sitting under a surfboard. So, I didn't grow up surfing, but I like to go. It's a lot of fun.
So inflections remind me a lot of surfing. So in surfing, you've got to be a good surfer if you're going to have a successful outing, but you also have to have a wave. And the surfer doesn't create the wave, right? So, and without the presence of a wave, when it comes to surfing, at least, there's nothing to really talk about, right? You're just out there floating in the ocean on a surfboard. And so what I realized was that technology startups are very similar that way. Why is that? Well, the startup needs to have a way to fight unfair. If the startup is using the same technology as existing companies, all they can be is incrementally better. And so what the startup does is they leverage an inflection, a change event external to the startup, to show up with something radically new and different that's never been seen before. So, we talked about ride sharing a little bit ago. The iPhone 4S was the inflection. So the iPhone 4S had an embedded GPS chip in it. And so you could have had the idea for ride sharing before the iPhone 4S, but it wouldn't have mattered because you couldn't have, the wave wasn't there yet, right? There wasn't any motive power to propel the idea. Now, all of a sudden, the iPhone 4S comes, but if you'd waited too long, then the wave breaks and other people catch the wave, right? And so the key with these inflections is recognizing that there's a window of time where for the very first time, a new type of empowerment exists that can radically alter human capacities and behaviors. And so then what the founder does is something very important. They have what I like to call an insight. And the insight does involve the skill of the entrepreneur. Just like the surfer has to pick a wave, now you got to control the board, right? You have to do something interesting with it. In the case of an insight, the lift, it would have been, that means you can do Airbnb for cars. So you had to connect the dots, right? What are the implications of the fact that I can use an algorithm to find people with a phone? Oh, that means I can locate riders and drivers in real time, and I can display them on a map, and I can create a market clearing price for supply and demand and all that. They had to figure that stuff out. But that's where the difference comes. One of the things about the insight is it needs to be non-consensus and right. It can't just be right. And the reason is that if it's consensus, again, it's too incremental. If everybody likes the idea, if everybody thinks it's going to work, that means it's too similar to what already exists, which means it's too incremental. So like with Lyft, the non-consensus part was, why are people going to want to get in a stranger's car? That's crazy. Now it seems obvious, but at the time that seemed kind of crazy, to get in a stranger's car, especially somebody you didn't know and never seen before. And so that's where the insight comes in. And the insight is really important because it's the thing that lets you be unique. And so we used the surfing metaphor earlier. It's not enough just to have a good wave. Maybe you've had this happen. One time I was out in Santa Cruz surfing at a crowded time, and there's all these dudes around me saying, dude, get off my wave, get off my wave. Well, that's not much fun. And so what you really want is to find an awesome wave, but you also want to find an awesome wave at a beach that everybody thinks is closed, where, you're the only guy out there pedaling and you miss it a little bit, you catch the next one. And so there's really two conditions that you're looking for. The inflection provides the empowerment. It lets you show up with something that nobody's ever seen before that's radically superior to anything they've seen. The insight allows you to be the only one that shows up with it. And that's what you really want to be. You want to be the only person that exists with a certain thing that some set of people are desperate for because it's so powerful. And that's, when you get those conditions lined up, now you got a shot at being pretty good as a startup.
So thinking about these inflections, any happening today, like any general macro? I mean, I know everyone's talking about AI, right? And like that's probably, I imagine you see a ton of AI startups and ideas. But as you look around the VC early stage space today, and you can also feel free to mention any recent startups or investments. What are some inflection points that's on your brain here in 2025?
Yeah, well, I mean, it's obviously a really exciting time. It's a time to be a little bit careful, I think, because it reminds me a little bit of the early days of the internet era. And two things can be true at the same time. Something can be overhyped, but the hype can be long-term real, right? So I remember in 2000, if you'd bought stock in Amazon, you would have lost 95% of your money, but then you would have made 500 times your money on the other side of that. And so Amazon was clearly a long-term valid major change event. But still, I'd probably rather not ride it 95% of the way down on the way up. I'd probably rather just wait till it's a little bit lower priced and buy it and get even more benefit of the upside. So that's the challenge that we face today, is that there's no question that what's happening in AI is really exciting and profound and a sea change, more than an inflection, it's a sea change. But then you got to say, okay, well, who doesn't know that? And how do you find ideas that are non-consensus and right? And I see plenty of AI ideas where I'm like, I can totally see why people will want this. I can see why I would want it, but I just don't know why there won't be 10 just like it. And if that happens, then I can't invest, because I can't invest in something that I don't think has a fundamental insight. The problem is your opportunity gets arbitraged away from the competition. And so you have to, we were talking about Peter Thiel a little bit ago. The part of it where he talks about monopoly that I really agree with is you want to stand alone, right? You want to escape the comparison trap completely. You don't want to be better than the competitors. You want to transcend competition and break free of it. And so that's been the challenge with AI. We've made a few investments here and there, but not as many as some are making. I'm also interested in Bitcoin. For me, it's sort of the cryptocurrency that's hidden in plain sight. And everybody's been investing in Ethereum and smart contracts and Solana. And I think there's a lot of virtues to those ideas as well. But if there's a world where Bitcoin becomes as mainstream adopted as gold, there would probably be an entire financial ecosystem built around Bitcoin that would be really interesting. And I think that not enough people have been paying enough attention to that. And I think that now there might be some interesting change events, talk about inflections, regardless of your politics, Trump's posture towards crypto is certainly a major change event in terms of the opportunities and upside in crypto. There'll probably be more scams too, by the way. And so, you may go from tyranny to anarchy when it comes to crypto on the way to long-term stability, but still, it's an interesting change event and an interesting opportunity.
There's a question I've always wanted to ask someone in your shoes who's done it a bunch and has been around for a while. The listeners on here have got to hear me talk about my angel investing journey. And, we started over a decade ago. And as a quant, the insight that I thought was really important from my side, and, kind of doing this from an outsider perspective, really coming to this with the belief that, this was going to be tuition for me. I may not do well. I'm at peace with that. But really the understanding that I wanted to make a lot of bets and a lot of small bets because of the power laws you were talking about, right? And I look back at the hundreds of angel investments I've done now, and I really wish I'd gone back 10 years ago and marked each one of them at the time I made the investment. So it's a yes, right? So it's not all the thousands I didn't invest in, but it was a yes, I invested, and marked it like 1 to 10 on how confident I was that it would be the big winner. I wonder how much correlation would they would be, or just be a scatter plot. Have you ever thought about this where you look back and you're like, you know what, damn it, I knew Twitter was going to be a monstrous success. And these others, yeah, I thought it might be. Do you think, like, how do you think about that when you're making these today? Is confidence play a role, or is it like, no, once it's a yes, it's kind of...
With startups, you have to believe even when you don't believe, because as a founder, you just wouldn't be able to do the job. There's just too many times where you're on the verge of failing, and there's too many negative signals you get. And so once we invest, we're pretty much all in. We're pretty much co-conspirator, emotional, sort of part of the conspiracy to change the future with the founders. But I would say that if you look at these funds that have done really well, even the ones that have made more than 10 times their money, their loss ratio isn't that different. And so when I invest, I have a little bit of a different investment thesis. I say, look, even if I'm doing a great job, I'm 85% likely to lose money. And so the question is not whether I'm likely to lose money, and it's not even whether I think this company is likely to make money. How can I make that claim? Because even the very best of the business are wrong 85% of the time. So it turns out that being right in my business is not about avoiding being wrong, how confident that you are that you're right. It's about having a mechanism to decide which opportunities embody enough upside, where in the 15% case that you are right, it's huge. And so, when I think about, in physics, they talk about potential energy and mechanical energy. And potential energy is like I'm holding a pen up high and it has the potential energy. If I drop it, it hits the floor and it breaks, then it converts the potential energy when it was in my hand into mechanical energy of hitting the ground. But energy isn't lost or gained, right? It's conserved. And startups, what I find is that almost all of the energy or value is potential value. There's no actual mechanical value created yet. Whereas if you're late stage, if you're Warren Buffett, it is about mechanical energy. There's results to analyze. There's profits. There's, attributes of the business that can be understood. And so, you're just, the unit of analysis is just different. I think that I like to say Buffett is fantastic at seeing reality better than the rest of us do. And he sees the reality of the truth of a business's ability to compound for a very long time. Whereas I like to say that a startup investor has to see what could be and has to kind of say, given that it's 85% chance of going wrong, what could go right and how right is it? And how right could it be? And that's where the art and the science is, right? Is figuring that out. And that's why it's hard for most people to context shift, right? It's really hard to do any other kind of investing simultaneously with angel or seed investing, because it's just like, it just operates under a totally different set of laws and gravity and space-time, right? It's just completely different. It would be like, no, the world's not in Cartesian coordinates, it's polar coordinates, right? You just have to understand an entirely different way of interpreting the world and events and those types of things. And so that's kind of how I see it. But I never have an investment thesis where I say, I'm confident this company will succeed, because that would not be intellectually honest to me to say. The better way for me to show up is to say, this is how big it could be if it does succeed. Is it big enough? And that's kind of how I like to think about it.
So given all those parameters, how do you decide on 40 as the number? Because I feel like, again, as a quant, I feel like, all right, I got to get a couple of these big winners. I feel like I should err on the side of more maybe 80 almost even.
It's a great question. And I'm not sure you ever get comfortable. But here's the way I look at it is you have a tension between two different variables. So the first variable, as you rightly point out, is how many shots on goal do you have? So if you have 40 companies in your portfolio, you have half as many shots on goal as if you have 80, say, or half again as many as if you have 160. The issue, though, is you've got to also care about the magnitude of your biggest win. And so if you have 40 companies instead of 80, the magnitude of your biggest win on average will be twice as high, because you're making twice as big a bet per bet. So you have two things at tension. If I had a portfolio fund of just one company, well, if I invest in Google, it'd be the best fund of all time back in the day, right? At one investment, it was Google. But the problem is, if you had one investment, usually it's not going to be Google. There's an 85% chance that fund's going to return zero. And so one feels like too few, although the very best funds of all time have fewer investments. There's survivorship bias for that reason. But like if you have 100 investments, then your biggest investment has to return half of the fund and it's 100th of the fund, right? And so the multiple on your first check has to be a lot greater. And so what I like to say is in venture, the size of your fund and the number of investments you make, it's a lot like qualifying for the pole vault in the Olympics. You're putting a bar up and you're saying, I'm making a commitment to clear that bar. And so if I raise $100 million and have 40 investments, I'm basic rough math, right? $2.5 million per investment, and my best one has to return $250 million if I want a 5X fund. And so I'm saying to my partners, one of my companies out of 40 will make 100X. And if I don't believe that, I shouldn't raise money. I shouldn't have a fund size that big or that many portfolio companies, because I'm not going to clear I'm going to, in the Olympics, they call it no height, right? I'm going to fall short of the bar and get disqualified. And so that's how I look at it. And so you have two things at tension. You have how many shots on goal you get, and you want a minimum number so that you get any big outliers. But then if you have too many, then the magnitude of the outliers that you get won't be big enough. And so, I like to say it's a function of what I call picking skill. What percent of your picks are outliers? And the higher your picking skill, the smaller your portfolio can be. That's kind of what it comes down to, I think.
A little bit of art, a little bit of science. Where, comfortable, where do you feel is the sweet spot? One of the things you talked about, I was laughing, I was reading it. You had a quote where you're like, breakthrough companies need to be built by missionaries, not mercenaries. And then you talk about like being disagreeable. And in my head, I just picture my wife talking about like just being stubborn. And so I'm like always thinking like, is this a good quality? Is this a bad quality? Maybe talk to us a little bit about this, because I imagine there's been times when you got to start up, and he's like, no, like this is what we're doing. And other times like pounding him on the head, be like, no, you're not seeing it. You're just being a blockhead. How do you think about that?
Yeah, well, the interesting thing that I've seen is that fundamentally a startup is a disagreeable act. So a startup is a disagreement with the present. It's an affront to the current sensibilities and patterns of how things happen. And so, the very word status quo has the word status in it. You're going to have people protecting their status as a function of wanting to persist the status quo. And so if you're a founder, you got to make some decisions about what's important. Do you want to fit in to the status dominance hierarchy and get along with folks all the time and keep the peace? Or do you sometimes have to break some glass? So like, for example, the Lyft guys, at first it was called Zimride, and they had this corporate commuting service. And then one day they decide they're going to do an experiment where we do peer-to-peer ride sharing. We put these pink mustaches on cars. And my partner Ann's in a board meeting, and they're going through the pros and cons. And one of the cons is it's illegal. And Ann says, okay, well, is it legally ambiguous, or is it just straight up in your face illegal? And they say, oh no, it's clearly unquestionably illegal. So Ann says, well, is this thing going to rock people's world? Are people going to love it? And Logan Green, one of the co-founders, who's pretty understated, says, I've never been more confident of anything in my life. And so Ann says, his legendary response, well, I guess we'll have to get the law changed then. Here's the thing though. Most people, it doesn't occur to them that launching an illegal service is one of the available options. What was the alternative? You could have gone to the San Francisco city government. You could have said, great news. We got this new idea. It's amazing. People are going to love it. It's called Lyft. We just need you to tweak this law so we can launch. What would they have said? They would have said no. Of course they would have said no. So the only way that you're ever going to see if it's going to work is to launch it, have people fall in love with it, and then you're negotiating with the San Francisco government, but now they've got to take something away from people that they really like. And if you're not willing to do that, then you're not going to fulfill the mission of the enterprise. And so what the founders have to do very often is they get into these situations where the present fights back. It's not going to fight back fair. The taxi lobby is not interested in negotiating with Lyft and Uber. They're not looking for some win-win agreement. They want them out of business, period. And so, when you're in a situation like that, you got to decide if you want to fit in with what is, or whether you're going to have to, ruffle some feathers and break some glass, takes cracked eggs and make an omelet. I don't see any escaping that. It's not always about doing something that seems overtly hostile to the present. Like Justin Kahn, before he started Twitch, his prior company had a calendar software, and then Google launches a Google Calendar. And Justin and Emmett are like, okay, well, we're out of business, so I guess we better sell this thing. And I heard online that they'd sold this company on eBay. And I'd never seen anybody sell a company on eBay before. I didn't even know you're allowed to sell companies on eBay. But that's part of being disagreeable too. It's like disagreeable is not about just being overtly obnoxious for its own sake, although some founders are. It's really about saying there are certain times you got to be willing to say, I disagree. And I'm not going to just go with what the other guy says. I'm going to chart my own path and do it my way. And, even if it makes some people uncomfortable, that's what I'm going to do.
Your career has kind of spanned, as a VC, an interesting period where a lot of companies have decided to stick around the private markets longer. You've had some new interesting areas for liquidity. You've had publics dipping into privates. You've had privates that are now, I don't know, what's SpaceX, $300 billion company is still private. Are we ever going to get any IPOs again or direct listings? What's the gates going to start to open up? How do you feel about the VC market here in 25? How are we looking?
I don't know if it'll ever be like in the really good old days back when I was a founder, kind of in the 90s. A lot of companies go public in 3 years, 4 years. That was a pretty mainstream outcome if things worked. That almost never happens now. I think that the stay private longer feels like it's a little bit here to stay. It feels like the scale that you need to be public is greater than it once was. And there was kind of this little walk on the wild side experiment with SPACs, and that didn't go so well. And so I don't think that the attempts to have more and more companies go public sooner before they're ready really panned out. So I think fundamentally what that means is that the magnitude of your winners has to be higher when it works. And so if it takes longer for it to be realized, you not only do you have to get paid for the risk, but you have to get paid for the lack of liquidity for longer. And so I just think that's going to come with the territory, right? You have to be finding these companies where if they work, the results are so astronomical that it covers all sins. I don't see that changing.
Let's bounce around. We got a few fun questions. If someone was able to open the pages of your surprise journal, what would be some recent entries? Anything on your brain you've been thinking about, surprised about?
I'm surprised at what an individual can do with AI. I've spent a lot of time just playing with the tools and trying different experiments, and it just feels like a superpower. So what I guess the biggest surprise for me the last 6 months is the idea that very small teams can massively force multiply. And so like I used to sit here and think, man, I'm this tiny little fund, $150 million, and there's funds out there raising billions, sometimes tens of billions of dollars. How do I compete with them? They have all these fees. They have giant teams. They have lots of budget to spend on programs and awareness building. Now I feel the opposite. Now I feel like, man, it'd be hard to run one of those big firms because just the coordination costs of keeping everybody on the same page is just crazy high. I've got this collection of what I call 100 bagger startups. And so I try to create a time capsule of every great startup, what it looked like in the seed round. And because I have all this data and I study this, it's easy for me to use the AI to do a lot of really interesting things. For example, I might be interested in, people are saying AI is going to enable a shift of business models away from software as a service to technology enabled service. Well, then I can say, okay, well, what are all the 100 bagger startups that have been technology enabled services? Or I can run the AI against business model canvas and run what if scenarios 10 different ways and pose a lot of what if questions and come up with lots of anomalies to look for. And then I can ask the AI, okay, please consider this list of 100 bagger companies in business to consumer. What do you think will be similar or different about them in the next 5 to 10 years and why? And I can ask that to not just Claude, but ChatGPT. And I can, ask it in different ways. And just the amount of insight that you can gather in a given amount of time and effort invested is extraordinary. And then there was this other book. I'm trying to remember the author's name. It's called 100 Baggers. It was written about public stocks. I love this book. And I thought, on the weekends, I'm going to try to find these 100 bagger stocks, the coffee can metaphor. And I was like, but, how am I going to ever have the time to implement the strategies that they propose in that book? Well, now it's trivially easy to do that. Now I can use the AI to create the equation for all the things that you should care about, and I can run it against thousands of companies. And so now I have the tools that a massive team would have, and now it's just, am I more patient than the other guy who's investing? And I think I can win that game, because one of the things I learned from Swensen, we talked about him earlier, is patience is a form of arbitrage. Most people think liquidity is good, but actually I think it's as much of a bug as a feature, because what you realize is that if you're buying assets that you have to hold for a long time, you don't have much competition because not many people want to do that. And so you end up competing less for those assets, which causes them to be systemically underpriced in many cases. And so I think also patience is a form of arbitrage in your willingness to hold a stock. I could have never acted on that insight very well because I just didn't have the tools to do the analysis that I'd need to do to feel comfortable about it. But now my wife, Julie, and I on the weekends, we just do our little 100 bagger analysis. We trade ideas and we look at it and stuff. And it's fun to, do it with the kids and stuff. It's fun to talk about and think about. And, I only have to pick about one stock a year. It's almost like in so many fields, the knowledge pre-existing in the world is now available to you at your fingertips. And it's just such an awesomely powerful idea. So I'd say that's my biggest surprise. I mean, I knew AI is important. Everybody does. But I just didn't realize how good the tools were going to get and how useful they'd be for a guy like me.
I keep saying I'm going to spend the weekends trying to get really up to speed on putting these into place. And then, as you know, 7-year-old creeps in. It's a little harder. But we've had Chris Mayer on the podcast, author of 100 Baggers. And I was looking on my
that's
bookshelf.
The one.
Yeah, trying to find it. We recently saw the passing of arguably one of the investing goats, particularly in the asset allocation world, Yale CIO David Swensen. And it sounded like he was a early LP for you guys. Would love to hear if you had any thoughts about Swensen, any fun stories.
I remember when we first got started, we would think about who we would want as investors. And when you're a venture capital firm, it's kind of like saying, I want Dave Swensen to invest. It'd be kind of like saying I want to be a college football player with Nick Saban or something, right? It's just like he's kind of a legend in the endowment field. And so we started to get to a point where we were having some success, and we started to talk to the Yale people. And your first meeting with Yale isn't Dave Swensen, right? They have to vet you and some things. And one day he came out to visit us, and we were in California, and the power went out because there was this big rainstorm. And he showed up a little bit sooner than his team. It just so happened that his ride got there quicker. And so my partner Ann and I, who we started Floodgate with, were lighting candles in the conference room so that there'll be lights. And Swensen gets there first, and he just decides to walk in on his own. So he sits down, and we're sitting there in a dark conference room lighting candles, and he starts to just ask questions about our business. And I have this term that describes the startups we try to invest in. We call them thunder lizards. The metaphor comes from Godzilla. And, Godzilla hatched from radioactive atomic eggs and emerged from the ocean and started swiping holes in buildings and breathing fire and eating trains like they were sausage links. And I'm telling this story to Dave Swensen. And he just kind of gravitated to the concept. And so the rest of the Yale team came in, and this is like the first time I've ever met him. And, the rest of the team came in, and the whole rest of the meeting, he'd be like, tell me more about thunder lizards. There are so many things I learned from him, much more important than the fun stories and stuff. The thing that I think a lot of people don't realize about him was he wasn't just a successful, impactful investor. He really was a great person. He had a great strength of character and just some sensibilities to him that I really respected a lot. It was an opportunity of a lifetime to get to work with him.
Yeah, he seems to be kind of universally respected. It's funny because I read this book this past summer and when it came out, but you have a fun story where you're talking about second grade you. I actually have a second grader right now, and you're talking about reading Jonathan Livingston Seagull book. People watch this on YouTube. You see me covered in some white powder. It's actually cornstarch. Today was Newtonian fluid volunteer day in the science lab. But anyway, to tell us a little bit about that book. I read it for the first time this year. I had never even, I don't even think I've ever even heard of that book before. Tell us a little bit your reference to the Seagull book and why it matters.
Yeah. So in the early 70s, there were some books that I thought were really interesting in hindsight that my dad was interested in. One was Jonathan Livingston Seagull. The other was Zen and the Art of Motorcycle Maintenance by Persig, and then Be Here Now by Ram Dass. And so Jonathan Livingston Seagull's this tiny little book, and I just saw it in his office one day, and I asked him what it was about. And my dad's style was to kind of say, well, what do you think it's about? Why don't you read it and you tell me what you think it's about? So I read it, and it's about this bird who's a seagull, and he wants to achieve perfect flight. And he's in this flock of seagulls, and all the other seagulls say, why would you want that? You're a seagull. And our destiny is to be these dirty, yucky birds that eat the scraps off of the surface of the ocean. And we're not meant to be fast flying, cool birds. We're meant to be scavengers on the surface of the ocean, getting whatever we can. And, he keeps getting obsessed with wanting to fly fast. And it gets to a point where he ends up getting cast away from the flock. And they don't want to hang out with him anymore. So he ends up finding another kindred spirit, and then he learns how to achieve perfect flight. So I talked to my dad about it later, and he said, what did you think it was about? And I didn't have the vocabulary exactly that I would have now, but the thing I got from it was something to the effect of the limits that exist in your life are not usually limits of the world. They're usually the limits that you impose on yourself in your own mind. And that if you want to achieve limitless success and a limitless potential, you need to break the chains of your own thought. You have to break your own limiting thoughts in your mind. That's a more important set of barriers to overcome than anything that's out there in the world that's trying to stop you. And he was kind of like, not bad. That's pretty good. It's a pretty good take. But that book, when I was a kid, really influenced me a lot because I noticed that a lot of people all the time, and we ourselves, even in our own mind, we allow ourselves to buy into the limits all around us. We allow ourselves to play the game by the rules that are defined by somebody else. We just accept things for what they are. And a lot of times life gets a lot more interesting when you realize that life as we know it, usually it was defined by somebody else who just had the courage or the independent thought or just the wherewithal to just say, hey, I think there's a better way. I'm going to try this way. And so I always liked that book. And, Richard Bach is just such an amazing author. He wrote some other great books too, like Illusions, and he ended up being pretty famous in the 70s for this book. So that was the other thing, is just his style of writing is just so, it has a lot of whimsy and wit to it. So, it's also just a very magically crafted book and a very well conceived story. So I've just always been a fan of Jonathan Livingston Seagull, right? Ever since I was a kid.
Do you know what your most popular tweet is ever?
I don't know. It's probably a picture of my dog.
No. You had a tweet.
I'm almost afraid to look.
No, it's not. It's good. It's fine. It was last year. He said, I don't care who people vote for, but I wish basic economic and financial literacy was a high school requirement. And we talk a lot about this on the show. We've done a bunch on this concept. How do you think about how to teach kids how to invest, or even just about financial topics in general? Are there any sort of ideas, concepts? I think we even start teaching it in like elementary school, money and just ideas about how to think about probably arguably the most useful skill that every single person will have to know at some point, instead of shipping off these 18-year-olds to say, hey, should you take on 300 grand of debt, or should you buy a house? Should you get a credit card? What are your ideas around this topic?
My awakening to it was, there's this guy named John Hope Bryant. So there was this time where I was asking the question, why aren't there more Black entrepreneurs in Silicon Valley? There's all kinds of different opinions about it, but I was like, I should at least do some work and try to figure this out. So I talked to a bunch of people and I read some books, and then I read John's book. He wrote this book called How the Poor Can Save Capitalism. And I realized after reading John's book that I didn't know squat about the problem, and nobody in Silicon Valley that I knew squat about the problem, that we were just living in a different universe. So like what John helped me realize was that like, and by the way, this isn't just for Black people, it turns out anybody in a zip code with a low FICO score average, this applies to. But the example he used in the book was a lot of Black people grow up in this country where the only two stores near them are the liquor store and the payday loan store. And they never learn that the monthly price of your loan isn't the only variable that you should care about, right? That there's interest rates and a bunch of, they never got the memo. They never understood the idea of saving and compounding and all these types of things, the impact of that. And so what John said that really struck me was that financial literacy was the next civil right, and that everybody in advanced societies should have financial literacy in the same way that they are able to read words on a written page, that it's just such an important life skill. It's so important and impactful to one's success in the world. And not just in terms of how much money you have, but in terms of just your basic understanding how the world really works and how value gets created in the economy. And so been really interested in that. And John's done some really good work on this with Operation Hope, and he's raised a bunch of money and brought a lot of visibility to it. But like the AI tools give me a lot of reason to be optimistic that we could, there's a bunch of problems that we have in education that are about to get to a threshold where the only thing that will stop us is our will to solve the problem, because we will have an infinite supply of patient educators. There will no longer be an availability problem. There will no longer be an access problem. There will only be a willingness to get educated problem. And that's still a legitimate problem. But that's good, right? Like in the past, you might have said, even if I believe financial literacy matters, you wouldn't have been able to hire enough teachers. You wouldn't have been able to embed it in the curriculum. There's just too much between that idea and operationalizing that idea. But we're heading into a world where anybody who wants to be financially literate will be able to be. And now we just have to help parents understand that it's an important obligation that they have their own children to make sure that that comes true for them. Because if you don't have financially literate children, you're basically excluding them from the upside opportunity of being a citizen of the U.S. You're handicapping their pursuit of the American dream. And so like I feel like it's one of the most important duties of parents, and you can't count on the schools to do it. But the good news is now you don't have to be a teacher. You don't have to have a lot of resources. Soon the AI tools will be better than any teacher's ever been at teaching it.
Yeah, it's gonna be fun to watch. I like, we had Brad Gerstner on the podcast talking about his Invest America idea, seeding children born in America with a brokerage account, which I think is interesting because it gives the one of the things I think missing for a lot of people when you try to teach this is it feels too distant. It's not tangible, but having a connection to what's going on in the real world. Certainly, I remember back in the 90s, I was in high school. I know a lot of these tech stocks. This was my favorite bubble, right? Like a really fun time. But I remember, looking at the newspaper with my dad, looking at quotes in there, which used to be back in quarters and halves, and, looking at Lucent Technologies, looking at AOL and SeamGI and all these others. But, if you're not engaging in these sort of ideas, it's a lot harder to discuss the concepts, So I get really frustrated. A lot of critics say, well, you can't teach financial literacy, people forget it. And I say, well, you're probably just teaching the wrong thing or you're not a good teacher. Come on, that's such a terrible approach to it. But, hey, maybe AI solves this and people can get the curriculum, and it'll be fun to watch.
By the way, this I didn't see your interview with Gerstner, but I've heard him allude to this, and I'm curious about your take on something, Meb. So one way I've internalized it is people talk about UBI, Universal Basic Income, and I've always felt that they had the discussion backwards. Like the idea isn't to give people money so they can consume more. We don't have a lack of consumption problem in this country. In fact, that's why most people are in trouble, as they run up big debts on their credit cards and all that stuff. What I liked about what Brad was saying was I call it UBS, Universal Basic Savings. What you want to encourage people to do is to say, look, I'm not afraid of AI companies taking my job. I want to own a share in that company, and I want to be part of our shared manifest destiny of being a great country. I want to have a stake in what happens no matter what happens. And, the way I'm going to be a prosperous person is to change my time preference so that I'm not just trying to buy low, sell high this week, the latest meme coin or the latest, trade, GameStop, whatever. The way real wealth happens is through financial literate application of good decision making. And so I often thought that would be an interesting thought, like airdropping money that vests over 30 years to people. The only decisions you get to make is what vehicles to invest it in, but you do have to invest it. You can't just spend it on, stimmy checks and, what happened in COVID.
What I really like about Gerstner's idea is essentially it gives investors skin in the game in the sense that they're all on the same team. So like you're now cheering for the US to do well or GDP, and you're cheering for Apple or Walmart, to perform. And so you have a stake, right? So to me, if you look at the percentage of Americans that don't own stocks, especially directly, it feels like we did this old post. It's like 4 or 5 years ago now on the income wealth gap and some solutions. And this was one of our ideas where we talked about it. There's actually an interesting app, listeners, and I put a tiny bit of money into this, but because I love the idea, it's called Griffin. But it's an app that, there's a lot of these will connect to your credit cards, or, they'll round up the savings like Acorns, and you got the robo-advisors, and these are all great. But this one's actually, it scans all your credit cards, and then you can set the amount. It could be $1, $10, $1,000, but it'll buy stocks in the companies where you spend money. And I was like, this is actually a really interesting idea from a couple standpoints. It's like actually fun to look at. You pull it up, and I was like looking at mine. It was like GoDaddy, Amazon, of course, Uber, Lyft. And then I saw Intuit on there, and I'm like, son of a bitch, I hate that company. but as you see this roster of actual companies, and it gives you like a tangible connection, because I feel like that's what's missing about a lot of our world is people look at like, hey, look, we're an ETF manager. Hey, I bought, the SPY, But that doesn't feel as tangible to me as, hey, I bought Amazon or whatever. Anyway, it's also an interesting idea from the standpoint of it hedging your own personal inflation. So it's like money where you spend, you're hedging what the money you spend. And by the way, listeners, use the code INVEST. You'll get $25 if you sign up. I don't get anything, but you guys get $25. Anyway, I thought it was a fun approach.
And it's interesting. My grandfather did something that in hindsight, I realized was pretty wise. When I was in 6th grade, he basically said, okay, look, Mike, here's the deal. When you graduate high school, however much money you've saved in your bank account, I'll match it. And so, like, what does that do? You know, I'm in a store and I'm deciding whether I'm going to buy a stick of gum or not. I'm like, well, you know, it basically cost me 2x the price. And so I'd save, by the time I graduated high school, I'd save like $5,000. And, you know, it's not a huge amount of money, but it changes your relationship to money, and it changes your idea about what saving is. And so I think that was a real great gift that he gave me. It was worth a whole lot more than $5,000.
Yeah, because it gives you, again, it gives the skin in the game part too is meaningful. Like, I mean, I think everyone wants to work towards something. You feel great about the outcome and struggle along the way, right? One or two more quick questions. We'll let you go. We always ask everybody, you go sit down, you're hanging out with a bunch of your fellow VCs, and you sit down at a table, you're having a meal, having a coffee, having a beer, whatever it is, and you guys are talking, and you say something. This is a belief you hold about investing, or it could just be about venture capital in general, but 75%, so most of your peers don't agree with. You say it, they shake their head. What's a belief you hold that most of your peers would not agree with?
Okay, and I may get myself a little bit in trouble here.
Please do.
I believe that there are aspects of Christianity that are extraordinarily important to the health and functioning of the Western world and free society. And I think we underestimate that importance. And by that, I don't mean you should go to church necessarily or read the Bible necessarily, but there are things that Jesus brought to the world if you look at him purely through the lens of philosopher king. So he sort of said the scapegoating mechanism is a bad construct for how to resolve problems, which, by the way, before Jesus, that's how it was always resolved. The pagan rituals, you sacrifice somebody and then you have this big societal release and you get on to the next thing. He brought the idea of human rights, and humans have value for their own sake. The other thing that he brought that was very important is this idea of unconditional love. And so you don't have to agree with somebody, and you don't even have to buy into what they're saying, but like it's better, I think, to approach people in this world through a lens of I want what's best for them, no matter what they do. I may have to invoke consequences in certain situations, but I should try to be on a footing that says I want the best for all people, all things being equal. And there aren't conditions with that. I'm not gonna like you because you like me or whatever, or because you did something for me. And so, like, those ideas I think are really important. And I think that the secularism has kind of thrown the baby out with the bathwater. It's caused people to forget some of the great ideas that were embedded in the core tenets, first principles of Christianity. And I'm not trying to say this through a religious lens. I would say the same is true about forgetting about Aristotle or forgetting about Pythagorean geometry or Pythagorean theorem, Euclidean geometry. But like, they're just certain things that are great ideas that have stood the test of time that we shouldn't forget. And we shouldn't have to relearn those lessons because we're too dumb to see what's in front of us.
Last question. What's been your most memorable investment? Good, bad, in between? Anything come to mind?
It's got to be Twitter in the sense that, in the early days, it was a podcasting company called Odeo. Apple decides to give podcasting away. They decide they don't have a business and they've got this little side project. They're deciding what to call it. Are we going to call it Voicemail 2.0 or TWTTR? They don't even know if they're going to release it or if it's going to be a company. Then it blows up at South by Southwest. And I'm trying to invest in it, and I get a chance to invest. And then everything goes, there's always the fail whale. They can't decide who the CEO is. It just had so many things, so much drama And then one day I'm picking up my daughter at a play date, and her mom says, "Is it true you invested in this Twitter company? I just saw them on Oprah." And then, not long after that, the Arab Spring happened, and they'd had to not take the servers down on maintenance because the State Department said, "Hey, look, we think Ahmadinejad's trying to steal the election, and we want all this stuff in the historical record." And that was when it hit me that, okay, this thing's going to be giant. I was so caught up in are they going to make it or not? And what's the latest problem? And what's the latest thing to work through? I hadn't zoomed out yet and realized, okay, this is what I'm in it for, right? Is these kind of outcomes. And so that I'd say Twitter was the first experience I ever had like that, where I was like, wow, this is going to be way bigger than I ever imagined it would be. Another recent one that's been fun has been when you're in the airport and you see transportation networking companies next to the taxi. You see Uber and Lyft next to the taxis, and you're like, wow, that didn't even exist a decade ago. And here they are, just like a mainstream fixture now of travel and hospitality. So those are the fun ones when they really work, and when they're just everywhere all at once, much more broadly than you could have ever imagined in your wildest dreams. And so those are cool.
It's fun when something like that works out. Mike, best place people to find you? Is it Floodgate, Twitter? Where can they follow your thoughts and goings-ons?
Yeah, I'd say M2JR at Twitter or X now. Then I've got a Substack called patternbreakers.substack.com. Those are probably the best places to go.
And a podcast on occasion.
Yep, Pattern Breakers Podcast. Yep.
Mike, thank you so much for joining us today. It's been a blessing.
All right, thanks, Meb. It's good to see you.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.